My guest today is Dom Wells. He's a CEO and co-founder of Onfolio Holdings. Onfolio acquires and manages a portfolio of digital companies. Thanks a lot for coming to the HoldCo Builders show, Dom.
Yeah, thanks for having me. I've been following you for a while and seeing you kind of start doing more content like this. So looking forward to it.
Dom, 10 years ago, you were an English teacher earning $1,000 a month. Since then, you've started 2 companies, exited one, and taken the second one public on NASDAQ. Tell me more about this crazy journey and maybe all the way since graduating from university.
Yeah, sure. It's a funny one, but essentially, I graduated from university in 2006, and I just did a basic job for a couple of years just to get out of some of my student debt and my overdraft and things like that. And then I decided I wanted to go teach English abroad for maybe 1 year or 2 years, and I chose Taiwan. It seemed like somewhere where the cost of living wasn't too high, but the salary an English teacher could earn was reasonable compared to that cost. And my brother's wife is Taiwanese, so there was a little bit of a family connection as well. And then 2008 was basically when the world kind of had its last major recession. So I ended up staying a bit longer because Europe wasn't a fun place in 2009, 2010. So I just thought, I have a good job. I want to stay. But then it got to 2012, and I thought, well, I still like Taiwan. I could stay here, but I don't want to just make like $1,000 a month teaching English or $2,000 a month if I have a really busy month. But I don't really have any other prospects because I don't speak Mandarin, and there just aren't that many good jobs here if you're not a local. So I started to think, well, maybe I can make money online because then it kind of doesn't really matter where I am. And I read the 4-Hour Work Week and read Rich Dad Poor Dad books and kind of followed my nose and discovered internet marketing. And so I thought, okay, I should build a website, try to make some money through that. And I'm going to kind of skip the boring part, but about 18 months later, so now this is middle of 2013, I think I made $1,000 in a single month. So I thought, okay, it's taken me way longer than I thought. I thought I'd make money really quickly because that's what everyone thinks when they start out online. But $1,000 in a single month is real. And then I think it kind of accelerated a bit from there because it took me about another 6 to 12 months to make $3,000 in a month, but then I went from 3,000 to 10,000 in maybe 2 months or something. So once you kind of get a little bit of product market fit and confidence and momentum and stuff, it goes quite quickly. And so a business I founded in 2014 was really teaching other people how to make money online as well. I didn't set out to do that niche. It was really, I noticed that there were a lot of beginners buying these kind of turnkey websites off flipper.com, which is a bit like eBay for websites. And they were obvious scams. People would say, you buy this website, you do nothing, you'll make money overnight. And the website's like $200. So I was thinking, why are people buying this? But there's clearly demand for turnkey websites. So I started a business called Human Proof Designs, where I basically gave people turnkey websites that were actually legit, and I taught people how to use them. And I scaled that one to about $1 million in revenue by 2017. And so once I started getting a little bit of disposable income, I was buying websites myself as well. I was flipping them, and I'd buy a website for like 20K or something, grow it a bit, and then try and sell it for 40K and that kind of thing. And so naturally, because I had this audience, I started to tell them what I was doing. And it turns out there were people in my audience who didn't want to buy beginner websites for $500. There were people that maybe had $100,000 or $10,000 or $50,000 that they wanted to buy a website that was already making money, because they understood the ROI is pretty good if you can do it. So that gave me the idea to start Onfolio, which originally was basically like an asset manager. People would come to us, they'd say, help me find a website, do the due diligence on it, negotiate with the seller, and then I'll buy it and you can help me run it and charge a management fee and stuff like that. And this was now late 2018, early 2019. And so things moved quite quickly from there. A lot of people were looking for that kind of service. And so I basically realized I wanted to do Onfolio full time. Human Proof Designs had kind of stagnated a little bit. I didn't know how to grow it and I didn't really want to be involved with it anymore. So I sold it to somebody and that person was able to come in with renewed enthusiasm and grow it. So the business benefited from me leaving and I benefited because now I could focus on Onfolio and I had a few $100,000 that I was willing to use to just to hire staff and things so that Onfolio didn't have to really bootstrap from zero. And that's another reason we were able to grow a lot faster. And so then in 2020, obviously the world's starting to change and be a bit different, but I realized I didn't want to just be a service provider, basically just being like an agency helping people run websites. I realized there was a much bigger opportunity to basically build our own holding company, raise some money, use that money to acquire businesses, and then everybody's more diversified, all the benefits of a holding company. And then I realized if we took that public earlier rather than growing it really big or staying private, we could probably still kind of, it's hard to tell because there's never a chance to split test it, but we could probably grow faster and larger, and acquisitions would be easier, raising capital would be easier, attracting talent to work for you would be easier, and just building something significant would be faster. And so because 2021, 2020, the markets were so frothy, there was an opportunity to actually do it. There were investment bankers out there who saw the potential and were willing to underwrite the offering. And we were small and we knew we were small and that NASDAQ was a stretch. But we also knew if we could achieve it, then it would be the first step into building something bigger and better. So we went for it. We raised a little bit more money privately first just to pay for everything. And then Russia invaded Ukraine and the price of oil went up and the economy started going down. And the actual process of going public, which I'm sure we'll talk about, was not as easy as we'd expected. But took us about 6 months, I guess, 7 months, 8 months once we'd actually started the process. And we IPO'd in August 2022. So basically just over a year ago, about 53 weeks ago today. So yeah, that's kind of the story from teaching English to being a NASDAQ listed CEO.
It's been. I want to ask more question about the mindset as well, because you simply telling the story, it seems like it was just I just did this, then I did this, but I think living through each and every day, I think there was a lot of growth involved. This is we're getting there really soon. Before that, where is Onfolio today? What size? How many people? Revenue, profits? How much you can share? Obviously, it's public, but
yeah, I mean, as of the last reported quarter, I think our revenue run rate is just under 6 million US. Not profitable. So we had a cash burn of about 600K in Q2 2023, which is down from about 1 million cash burn in Q1. And in terms of people, it's a harder one to answer because in the central office, like the holding company, there's about half a dozen people. But across the various companies, there's some of the companies have 20 people working for them. Some of them have 5. So it really depends if we count them. One interesting thing is because we're scattered around the world, we use a lot of international freelancers, a lot of contractors. So all the financial websites, when they look at how many employees we have, they say 6, because that's like, in the US, an employee is a W-2 proper employee. So in terms of like actual employees, we have 6, but in terms of actual people, it's probably about 50. So it's kind of funny when you look at like Yahoo Finance and it says this public company just has 6 employees. But yeah, that's how it is.
Okay. Now, the mindset part. You posted something very, very interesting, that there are lessons you've learned the hard way in your 10-year journey, and you want to share those because you want to make sure others don't have it so difficult. So the first thing you said, you are the biggest obstacle. We live in the time where many people can achieve big things more than any other time in history. You need some luck, absolutely, but most people quit and don't even start because they don't think they can do that. You yourself, again, you have had a great journey. In which moment you found that you are the biggest obstacle holding you back doing XYZ?
I don't know if there was a single moment. I think it was when I was writing that tweet thread, and I was thinking to myself, what are the obstacles people need to overcome? Or maybe I'd been asked it on a podcast before, but I was looking back and reflecting and thinking, what are the hardest things? Why do people quit? And I think it's basically because people don't believe they can achieve it, or they hit some difficulty, and rather than overcoming it, they give up. Or I don't think everybody gives up the first time. I think a lot of people try very hard, but they do eventually give up. And so that's what I mean. It's like, it's essentially, it's, you just have to keep going until you don't fail anymore. And so there may be some people listening to this who maybe they failed 100 times. They've been trying for 3 or 4 years and they haven't succeeded, and they're like, actually, it's not that simple. Maybe there are some more things to it than just yourself. But at the same time, I would say if those people do just keep going, they will eventually have some success. And so the hardest thing is motivating yourself to keep going. And when you're lying in bed at night, wide awake because you've got so many different ideas, but you've also got anxiety and you've got stress, and you really hope you can achieve something, and you're kind of sort of daydreaming about having some success. But in the back of your mind, there's this doubt that you'll ever actually achieve it. And so you can't sleep because your brain is full of excitement and desire, but also doubt. What keeps you going is not really somebody saying you have to keep going. It's kind of like, for me, it was, I would have one small piece of success. Maybe it could be anything. Like maybe I reply to somebody I look up to on Twitter and they reply to me and I'm like, they replied, I can do this. Or maybe I get an email from someone who says, hey, I like what you're doing. Or maybe that website you were struggling to get any momentum with suddenly got a keyword rank on page 1 and you got a little bit of traffic. And I ended up just collecting all of these little small wins and joining them up together. So maybe I'd feel miserable for 2 or 3 weeks, but then something good would happen and I'd get really excited about it and keep going. And then whenever later I would feel like throwing in the towel, I would say to myself, well, you felt like this before and then something happened, so you just have to keep going. I think I'm where I am not because I'm cleverer than other people or because I'm better at marketing or communicating or anything. I think I just have this refusal to quit, and when something doesn't work, I just think, what else can work instead? So yeah, that's kind of what I mean. Like, the only thing that really stops you succeeding is that you stop trying. So if you can get out of your own way, then sooner or later you'll get there.
I did something similar in the beginning when I started building my holding company. I bought a course on self-education, and this guy said that there is a your current version and your new version. And I pretty much created a version Mick 2.0, and I changed so many things about myself. I changed the clothes I was wearing. I even changed my haircut, all those things, because changing some of the things outside, for me personally, it was easier for me to change internally. And what I mean in here, asking bigger questions, for example, raising money, I haven't done it before. And now sometimes we're having a meeting and you have to make an approach for, we would like to acquire 5 million euros. And back then it was pretty much impossible. So I just found this that you brought out, that you are the biggest obstacle, like 100% true. Another thing you've said, everything is learnable. Again, you were a teacher making $1,000 a month. And you also said you can start with no skills relevant to your field and just learn as you go. I'm not good at anything isn't an excuse. Maybe you can shortly share how was it, the process of learning those lessons?
Yeah, I think I would probably add to it that it's not that is true, but I also think it's a case of trying. It's tough to find a balance, but I found success with SEO and building online businesses because I was very shy and I could sit behind a computer and just work, and I didn't need to interact with anybody. I didn't need to convince anybody um, uh, to like buy my products or anything. So before I succeeded with SEO, I tried doing like multi-level marketing, and I was hopeless at that because it's too in person. And I also tried day trading, or maybe not day trading, but just swing trading and just trading with I forgot what they're called in the UK, spread betting. And I think if I had stuck with any of those things long enough, I would have learned them and got good at them. But I think you also have to try and find the thing that's for you. So maybe if I had just said, right, I'm going to become the best person in the world at selling protein shakes through an MLM, I probably could have got there, but I didn't. I also hated myself. Whereas SEO worked quite well. I could sit at home, write articles, read stuff, learn about changing my website to make it rank higher, and then I could go to work and come home and stuff. Maybe other people hate SEO, but they're able to find success with paid traffic, or with being a YouTuber, or with being writing a newsletter or something. And for example, YouTube is something I don't think I'm very good on camera. I'm too monotone. I'm too English, and so maybe I would never be able to be a successful YouTuber. But for the person out there who vibes with being a YouTuber, or is kind of that's what they want to do, then yeah, it's learnable. You can start with nothing and be like, this is the thing I'm going to try. And I think the challenge for some people is you also have to stick with it long enough to build momentum. And so there are probably people out there who try one thing for 3 weeks or 3 months and don't see any success. So then they think, well, maybe I'll try the next thing. So for me, I tried SEO and I did it for, I don't know, like I was saying earlier, about 18 months before I made $1,000 in a month, and probably 6 months before I made $500. But I didn't really switch off it and try anything else. So yeah, I think I would say you can learn anything, and you should try lots of different things to see what really is the thing you want to get good at. But also don't try too many different things, because you're not going to get good at anything if you keep switching. So that's a bit of a challenge, and I guess that's part of what I mean about you get in the way of yourself. But honestly, yeah, it's like right now you can learn anything. Some things are easier than others, but there's nothing really stopping you except your own ability to self-educate and just try the things that you're learning. So
going more in details with Onfolio Holdings, the process of going public, you've said before that you pretty much had to learn to speak the language of investment bankers. Can you share more about this journey of taking a business public?
yeah, and the first thing I did was it wasn't an interview, but it was kind of an interview with an investment banker who had learned a little bit about Onfolio and was friends with one of our advisors. And we had a call, and he asked me about my business. But he kind of already knew the answers. And what he was really looking at was, am I able to describe the business in a way that investors will like? And they, can I sell the business? If they put me in front of investors, will investors be like, yeah, it's interesting, we're going to invest, or it's interesting, but we're not going to invest? Or will they be like, who the hell is this guy? Why did you put him in front of us? And the feedback I got was, you need to improve in that area, but at least like your business model makes sense. And so I was like, well, everything's learnable. So, teach me, practice asking me questions. And I've probably learned more since going public than in the process of going public, and there's a few reasons for that. One is because we've been a public company for a year, and I only spoke to investors as a non-public company probably for 6 months. But everything changes once you're actually public. Now investment bankers want your business instead of you wanting their help. So they all make themselves available to you. They all try and sell you basically the same thing. But so you understand how they speak and how they think quite quickly. And so for me, it's really just been a continuation of my journey. Like when I started out as an English teacher, I didn't know how to run a website. I didn't know how to go on a podcast. I didn't know how to email someone being like, hey, can I come on your podcast, or something like that. And then I learned those skills. And now I'm speaking to investment bankers, but it's still the same thing. Like I'm scheduling Zoom calls. I'm messaging people on LinkedIn. It's just slightly more sophisticated spammers now. I think the hardest part really has been finance for me, because I didn't really necessarily understand a lot of the finance terminology, but also the mental models that people use with finance. So that's been the hardest part. And the other thing is, when you're a public company, it's kind of ironic because public companies are more transparent. They publish their financials and so on, but there's a lot less that you can actually say. So people have to ask you a question without really asking you the question that they're asking, and then you have to answer it in a way that says, like, I know what you're really asking me, but I can't tell you that, and I can't tell you that, so I'm going to say something else, and you're going to understand what I'm really saying. And so, like, for example, an investor might say something like, what kind of transformative things do you see coming up in the next year? And what they're really saying is, should I buy your stock tomorrow because the price is going to go up in a week? Or should I wait 6 months and buy your stock later? Or should I not buy your stock because it's never going to go up? And that's what they're really asking you. And you're kind of, well, I can't tell you anything that's going to make the stock go up in the next week because that's illegal. But I can't say nothing because maybe there is something coming up. So you just have to kind of talk about the things that you're allowed to say. So you just kind of describe like the stuff that's already public and explain it in a way that they're like, oh, okay, I see, you guys are probably doing something. Maybe they ask you a question about something in your financials, and really they're asking you a different question. So you have to kind of understand. And it's not all about like, I don't mean everything's about circumventing SEC rules about fair disclosures or anything. It's more about, there's a lot of loaded questions, and so you just have to understand what they really mean. And you have to understand incentives a lot more. So at the end of the day, the capital markets is all about incentives and sales, and analysts, for example, only cover a company if the analyst's boss, which is an investment bank, thinks that they're going to be able to do business with that company. And so that also means the analyst is probably not going to say anything negative about you or ask you any particularly difficult questions, because then you're going to give the analyst negative reviews, or you're going to be less likely to do business with the analyst's boss. So it's all kind of how it seems to outsiders is not necessarily something that should be taken at face value. Not like it's corrupt or anything, but it's just very confusing thinking about who's saying what and why. And so that's been quite hard to really understand for the first sort of, 6 to 12 months. Whereas now I feel like I've been public for more than a year because of just like how much I've learned since that. And going public was a similar experience, just shorter.
What type of companies you're acquiring? What is the perfect acquisition? Like cash flow size, profits, to buy 100%?
Yeah, we normally buy 100%. Yeah, we've started having conversations with people where maybe we'll buy 10%. We'll buy like 90%, and they'll retain 10%, or even 80%. But we always buy the majority, and so what we look at, it kind of depends a little bit on the type of business, but our ideal acquisition would have recurring revenue, usually like majority recurring revenue, and so therefore there would be low churn in that revenue. The margins really vary. So like an e-commerce business might have 40% gross margins, and that would be pretty good. And an agency, most agencies have kind of 30% gross margins, but it can vary. Whereas if we were buying a WordPress business, we would want to see, say, 80% margins. And a course business, maybe, well, if it uses paid traffic, then maybe pretty similar margins as well, like 40 to 80%. It can vary, but ideally it needs to have some element of recurring revenue, though in reality most of the businesses we buy don't have recurring revenue because there's not that many ones that we've seen that we're attracted to that we can buy for a price that we like, which have a lot of recurring revenue. Although this is I think this is going to change, or we'll start acquiring more recurring revenue. Typically we're paying 3 to 4 times EBITDA for a business. I think our average since the IPO is about 3.8. And it's not always EBITDA. Sometimes it's what's known as seller discretionary earnings, which could be because you're buying the seller's salary and things like that as well. And there's various add backs and depreciation costs that maybe you wouldn't take on that are in there. We like it to be something where if the seller's leaving, which most of the time they are, we think we can either hire someone to replace the seller or promote someone internally. There are sometimes businesses that we see where maybe the business is too reliant on the seller for, say, things like business development or producing content. So, for example, a podcast is quite hard to buy because when the host leaves, what have you really got? And so, you're very active on Twitter. You probably see it all the time. There's a lot of agencies where really it's just the founder is really good on Twitter and LinkedIn, and they drive all the sales to their agency. So if you bought that agency, you don't really have anything without that person. And so it needs to be something that can really survive, can thrive and continue without that person. And then it doesn't, similarly, maybe the number 2 person in the company who is fulfilling the business and the service and or providing some critical input to the business. we don't want it to be too reliant on them or their like technical knowledge as well. Because really, a lot of these small businesses, the ones we're buying are around, say, 500K to 2 million cash flow. These small businesses have this kind of entrenched knowledge in the business, which is from the founder and maybe some of the founding team. And when they leave, the real challenge is how can we allow the business to exist without this like embedded knowledge. And so it's something where we think, yes, we can hire someone who also has these skills, or the processes in the business are set up in a way that we can, the business isn't going to die after that person leaves. And then in terms of trajectory of the business and growth prospects and competition and things like that, it's all what I would consider fairly standard. Like, yeah, it needs to have good financials, it needs to be trending in the right direction, or if it's trending down, we need to think there's a compelling reason that we can turn it around and get a good ROI. So we're not necessarily looking for something that is like on its path to be a unicorn and we're going to pay 7 times revenue because of how quickly it's growing. That's not really what we do. Yeah, I think I probably covered that. But yeah, I could talk an entire episode more about some of the businesses that we've acquired.
Okay, so you said 500,000 is minimum acquisition target. How did you come up with this number? Was it based on your experience, or you just you made a mistake of acquiring a $200,000 business and you couldn't really make the changes? How did you come up with this number?
Yeah, I mean both those things are true. So it was we when we really started out, we were buying businesses that were like, making $1,000 a month or $3,000 a month, and it just wasn't enough to support a team. So then we thought, okay, let's have one central team and maybe 10 or 20 businesses, and combined those 10 or 20 businesses have enough profit to pay for the team. And what happens in reality is the team gets spread too thin, and now you have one team that's running like 30 businesses. And if you want to acquire more businesses to make it more profitable, the performance starts to dip. So you need to hire more team members, and then the profit doesn't ever improve. So you say, okay, well, let's start buying bigger businesses. But in order to do that, you need to be a lot more focused on those businesses, because bigger ones typically need more focus, but also there's more at stake if like one single business dies. So we started saying, you know what, we should really not have central teams running every business. We should have a dedicated team running each individual business, which seems obvious in hindsight, but I've spoken to so many people who are like, I have an agency, I'm thinking I might buy another business and have my agency run that business. And then maybe I can start a brand and my agency can run that brand. And I'm like, yeah, have fun. I'll see you in 2 years when you realize that that's not the way to go, because that's the journey I've just been on. And I did a blog post, I think it was January or February or maybe even March of this year, updating about how we made all these mistakes with centralization and we switched to decentralization. And so once we realized, okay, we should have decentralization and every business we buy needs to have its own CEO, we realized really 500K is that kind of minimum profit where you can afford to buy a CEO, because to hire a CEO, sorry. So if you buy a business and it's making, let's say, 200K a year, so that's around 180K, 18K a month, you hire a CEO, maybe that CEO costs 10K a month. So that's already using up half of the profit. Now, you could say to the person selling the business, your business isn't really making 20K, it's making 10K after we hire a CEO. So instead of paying you 800K for it, we're going to pay 400K. And then from a kind of valuation multiple, if the seller accepts that, which half the time they won't, but you're still sound. Like your ROI is still the same. But the problem is now you've got this tiny business that's only got a little bit of free cash flow left over every month. And it's just as much effort to run that business as it is run something double the size. We were like, why don't we just make 500K our minimum? And in fact, really, we want 1 million to be the minimum, but 500K works. It's just if all things were equal, we'd just buy businesses like in the 1 million to sort of 2 or 3 million range. And we'll probably get there in the next few years. But there happen to be quite a lot of good opportunities in the 500K range. So it's like, okay, this is the lowest we can really stomach. The only exception is maybe if a business is, it's like a bolt-on and it can become a division of an existing business and you won't need to hire a CEO to run it. Like let's say you have a content agency and you buy a small SEO agency to go with it, then yeah, you can accept less profit because it's not going to have the same issues that I just described.
What about the deal flow? Acquiring businesses no more than 4 times EBITDA. Where do you find such attractive deals? And how is the process in general? You reaching out to business, or it's pretty much the same like in all industries, right?
Yeah, I mean, it sounds like you do a lot of cold calling of like old people. we don't do that, but I'm sure we do pretty much the same elsewhere. I mean, where we find them is kind of everywhere. Before 2021, Forex was becoming maybe the mid-range, and we were seeing a lot of businesses for sale for 5.5, 5, maybe even 6. And now the really, really good businesses probably would still go for that. But we're seeing a lot more of the typical businesses that we like, which are available for like 3 to 3.5. So it's actually a really good time to acquire. In terms of where we find them, we have people we've hired who do direct outreach, and maybe we give each person a different mandate. Like you find agencies, you find courses, you find everything else. And then we have relationships with brokers who bring us deals. We look at marketplaces. I'm active on Twitter. I get a lot of DMs on Twitter with deal flow. I have people who hear me on a podcast and reach out to me. I have referrals. I have sellers who we've bought businesses from in the past. They come back to sell another business to us, or they recommend their friend comes to us. And I have a lot of friends, because I've been doing this business for 10 years, who have the types of businesses that I want to sell, that I want to buy, sorry. And so like a week ago, someone who I've known for, I don't know, 6 years, 7 years, just because we go to the same industry events, the same conferences, we've had dinner together, that kind of thing. They say, hey, I'm thinking about selling my business. And it's usually one of two things. They either say, are you interested? Or they say, can you give me some advice? And that might really be that they want to sell it to me and they just don't want to be direct. Or it might be that they genuinely want advice. And then when I'm giving them advice, I'm like, actually, by the way, I quite like your business. So it's all about networking and basically doing everything.
How much competition on the deals? And how much, 2 questions in one, how much easier or harder it is to acquire a company as a public company?
Competition has died off a little bit over the last year or so because I think 2 reasons. One, there's fewer companies now that are acquiring. Capital is harder to get. And 2, we've raised our minimums a bit as well. So we've moved up into a slightly less competitive tier. We've not had many, or maybe any. Yeah, we've had one deal where we made an offer and they went with someone else. And so we're in a pretty strong position as an acquirer, either because there isn't a lot of competition or because we have a good reputation, and I think we also are not blindly bidding on everything. So that means when we do make an offer with someone, we're able to make a more tailored offer that we know they'll probably go for. In terms of your second question, in many ways, it's actually easier as a public company, and in a few other ways, it's more difficult. So the reasons it's easier is there's a little bit of prestige involved, and people want to sell to a public company. It's also easier for me and for us as a public company because I'm some guy living in Asia, and my COO lives in Colorado, and my CFO lives in Portugal, and my president lives in Thailand. So it's quite hard for, if we were a private company, people would be like, who are you guys? But like as a public company, we've got credibility. It's also easier because typically more people are coming to us because they've heard of us. And if they're coming to us, it's generally going to be an easier process. The reasons it's harder is that there's only really two reasons. One is generally we're going to do a press release after we acquire someone's business. Sometimes, in some cases, we have to. If it's a large enough business, we have to file an 8K, and then we're going to do a press release as well. And so some people don't. They either don't want people to know that they sold, or they don't want people to know the price that they sold for. And the other reason it's harder is it just takes a little bit longer because, again, if it's a large enough business, we have to audit the financials. And we don't mean an audit like a due diligence audit or a quality of earnings audit. We have to actually do we have to get like a third-party public accounting firm do an actual audit to verify everything. We have to like transfer the books into a GAAP because they're not always GAAP, and then we actually have to pay a firm like 50 to 75 grand to audit the books and be like, yes, these books are actually real. And so that can be difficult for sellers because they're like, I already showed you everything. You already did the due diligence. You already know that I'm telling the truth. And we're like, yeah, we do. This isn't that kind of audit. And also it just takes like 4 to 6 months extra. So it can be, there's a little bit more like sort of managing expectations in the relationship. And also some people don't want to go through that process, which is kind of good because that also is a little bit of a flag. If they're not willing to go through that, then maybe they're hiding something. So it kind of helps us as well. But yeah, those are the main differences. I think overall it's definitely a net benefit. It's just a little bit more bureaucracy, and of course we also have a board of directors that we need to get them to sign off on the acquisition. But that's generally a good thing because the board are going to test your. They're not going to blindly accept stuff. They're going to ask you, why are you buying this one? Can you do anything to improve the terms? What do you think is going to happen after you buy it? And, things like that. So it's just like an extra layer of accountability, which is annoying, but like it's there for a reason.
You mentioned the online courses to be fascinating business, or in your tweet you even said online course acquisitions are a gold mine. I even run I would say consulting or online course business many years ago in Australia. A lot of people started asking on how I was pretty much subleasing apartments, and people paid from 1 to 5K, depend how much help they needed. And now these days, it's the one moment I think this thing went really viral for, I would say, young people on how to make money online. Pretty much a lot of them were selling different courses, and you saying that it's a high ticket product. Gross profits can be north to 90%. But what about the risks in these businesses? Because oftentimes it's the brand, it's the founder who's the ones I'm talking about are the guys who's showing fancy things on social media, watches, cars, planes, you name it. What are the risks there, or you don't even go for this type of businesses? You target more of something different. How is it in general?
Yeah, I mean, you kind of answered it right at the end there. Basically, it's a little bit of like a kind of flippant answer, but people say to me, well, what happens when you see a course where it's really reliant on the founder's teaching everything, the founder's doing Facebook ads, the founder's going to speak at conferences, people are buying the business because they love the founder. so you just don't buy that business. Those are great businesses to run, but not great businesses to buy because there's too much risk. But there are other courses out there where that's not true, or you can replace the founder over time, or the founder's willing to stay on. So can't really talk too much about it, but we've been looking at a few other course businesses where this is a thing that's come up. Maybe the founder does a podcast or something like that, and so we say, well, we'd be interested in discussing this more, but would you be willing to stay on and do the podcast, or would can we let you retain some equity, or can we hire you back to do the podcast, because that's something that we see as a risk to the brand. And yeah, so it's basically, it's a solvable problem. And if it's not a solvable problem, you just don't buy that business. The other risks are that you maybe make a miscalculation. So you think it's a solvable problem, but actually it is reliant on the founder more than you realize. Or the thing that the course teaches kind of falls out of favor, and it's not something people want to learn about. Maybe what you were teaching people how to sublease in Australia, maybe that doesn't work anymore. And so that becomes an issue. So, for example, with the business we bought in late last year about proofreading, it's like how to build a business as a proofreader. There's concern among shareholders or potential investors or whatever that that course is going to become obsolete because people are going to stop using proofreaders because AI is going to proofread. And that's not necessarily how AI works or how the world works. People are always going to use proofreaders. And the fact that now there's more and more content being created, you're going to need more proofreaders. So if anything, AI is going to help. But you have to kind of ask yourself, well, yeah, I mean, is this, like, we had that conversation before we bought it. And so is this a risk? Is it a real risk? If the real thing happens, if we buy the business and actually it turns out that's true, can we pivot the business or sell something else to that same audience and things like that? So it's really about trying to ask yourself, what are the various scenarios? How possible do we think they are? How would we react if they happened? And maybe we should just buy something else instead. So yeah, that's kind of how we approach it.
I want you to talk a little bit about the concept called Onfolio Flywheel, cash flow flywheel. Step 1, acquiring a business. Step 2, optimizing the performance. And step 3, compounding cash flow. I mean, done it right, it seems like an excellent compounding machine. And you've obviously thought more about this, putting together this concept. Can you share how it works?
Yeah, I mean, it's not something we've invented or anything. It's kind of how a lot of holding companies work. If you look at some of the software ones like Constellation or Roper Industries, or Berkshire Hathaway does it, but they've also got some sub flywheels within their insurance businesses. But the basic idea is you buy a business, let's say the business makes you $1 million a year profit. So you've got that $1 million. What do you do with it? Do you throw it back into the business to try and grow the business? If the business has very high return on cash return on investment, then yeah, maybe you do that. Or do you start a business and start a new division? Maybe you can do that. Or do you return that cash to shareholders? Or do you use that cash to buy back shares, which is another way of returning cash to shareholders? Or do you buy another business? And for us, the kind of the return on invested cash, or there's different ways of saying it, but basically the kind of return on cash, if we buy a business, it should be 20 to 30%. And so the way our flywheel is going to work as it spins up is we'll buy a business, we'll put some capital into that business or back into that business, where we think we can grow it in a not a risk-free way, but like a low-risk way, and then we'll improve the business. So some ways you can optimize and grow a business is not really through deploying capital. It's about understanding the business. It's about the fact that most people who are selling businesses to us have only ever run one business or two businesses, whereas we get exposed to probably 100 different businesses a year. So we develop best practices and processes where we understand, like, probably you can do this one thing to improve your business, and it doesn't necessarily need us to like throw more cash into it like a VC firm would. And so once we've optimized that business, we won't necessarily throw more cash into it. We'll just let it, keep spending the cash that it needs to grow and like in a stable way and to operate. But then the rest of the cash comes back to the holding company. So then we take that cash and we say, okay, we can either deploy this into one of our businesses which does have room to grow, or we can just buy a business. And really, when we're deploying money into an existing business, I don't necessarily have the same hurdle. So if I want to buy a business, I really want to try and hit 25% cash returns on like the first year with that business. If one of our existing businesses, the CEO says, "Hey, I actually want that $1 million for myself because I can grow it. I can grow my business a lot faster with it." The hurdle I would expect is 15 to 20%, and that's because I would rather grow an existing business than buy a new one, if possible, if all else were equal. And I don't think a CEO should have to meet the same 25% target, because acquisitions are risky and there's always stuff that you don't know. You buy the business, you think you've done good due diligence, and then you get the keys and it turns out none of the light bulbs are working, and you need to do all this other stuff. So whether we grow something organically or we grow through acquisitions, that's how it works. And then as more acquisitions are made and more businesses grow, maybe the next year we don't have $1 million, we have $1.2 million. So then we rinse and repeat. Just goes back into the business and grows it that way. So, like I said, it's not really a new concept. It's basically how a lot of these aggregators and serial acquirers work. We're just trying to replicate it with our particular industry.
Now, growing and optimizing those portfolio businesses, you've said that email marketing is the number one growth lever for our portfolio companies. Every business we've acquired had either zero email marketing or vast room for improvements. Can you tell more about what type of opportunities you see? Obviously, you acquire a business, you're already doing a due diligence. You see that, okay, the email marketing, they're probably not doing this. They might not even having a newsletter. What do you do when this is the scenario? What is the simple step-by-step what businesses could do to improve this part of the business?
Yeah, it's going to depend on the business, but usually the best case scenario is where it's already doing some email marketing. Like maybe they send one email a week or one email a month, and you can see in their analytics, or you can just see through other means that their email marketing is generating revenue. It's not just like a branding exercise. And then you might say to the founder, "Why do you only send one a week, or why do you only send one a month?" And the founder says, "Oh, I don't like email. Like, I don't like it when people promote their stuff to me via email, so I don't do it." And that actually happens a lot. So then we say, "Well, great. Like, we don't have that problem. So your audience probably don't have that problem either. So we're going to take over your business and send 2 emails a week or 4 emails a month." And it's never a silver bullet. Like, it never works as well as we think it's going to work. There's always a little bit of trial and error. Like, okay, try this, that didn't work. Try this, that did work. Try this. Oh, okay, that we actually lost money. Whoops. But there's always something that you can do. And there's another scenario where maybe they have an email list and they just haven't emailed it for a year. And that is, you kind of have to assume that's not going to work, because if they haven't been emailed for a year, is that email list really an email list? Maybe it's maybe it's gone cold or something. The other thing is, really, with digital businesses, email marketing is it's just like one of the big drivers of the growth. So even if the seller is doing a good job with email, they do like email, and they know, like 80% of the revenue comes from email. That's good for two reasons. One is there probably are still things you can do to improve. Maybe you can send them other offers. Maybe you can try and improve your deliverability, improve your copy. But also, when a business gets most of its revenue from email, that's generally good, because email is like the one audience source that you control 100%. Okay, sure, you can get blacklisted, or you can start showing up in the spam folders or something, but you can get banned from Twitter, you can get banned from Facebook, you can lose your Google rankings, but your email is like the one thing that they can't take from you. So it's a lot less risky as a kind of revenue generation than some of the other ones out there.
Little bit about the future. What's the North Star for you and for Onfolio Holdings?
Well, it's really about how well we can start compounding, because we've had a year as a public company and we haven't really compounded much yet, because we're still kind of in the process of escaping the fact that we're a small business with high costs. So the short term is get past that phase so that we're actually profitable, we're generating profits for our shareholders and able to start compounding that. And then it's basically kind of go into overdrive and just rinse and repeat, and keep compounding, and just try and grow. I think the beauty of what we're doing is there's no real limit on how high we can grow. We have to prove ourselves, we have to execute well, we have to overcome all the obstacles that will come in front of us, but it's not like we can only become $100 million company and then that's it. It's essentially, there's like no limit on how high we can grow. It's just a function of time and execution. So get to that point where the flywheel is spinning, and then just keep it spinning and accelerate it where we can.
Dom, let's wrap up with a famous five. How old are you?
38.
Favorite book?
Probably the Dark Materials trilogy, his Dark Materials.
Married, single, kids?
Married, 2 children.
What car do you drive?
I take a lot of Ubers. I don't drive.
What's the best investment advice you've ever got?
There's probably 2. One that always comes back to me is you don't have to get it back the same way that you lost it. And then the other one is not really a quote. It's more of a concept, but it's just kind of like, assume that all your assumptions are wrong, basically. So if everything I think about why I'm going to make this investment is wrong, is it still an okay investment? And if it is, then okay, that will survive the test of time.
Where can people find you?
Well, I've talked about Twitter a few times, so you can find me there. I'm just Dom Wells at Onfolio, and then obviously onfolio.com as well. I'm going to be starting a newsletter soon, so people can subscribe to me there.
Perfect. Thanks a lot for doing that.
Yeah, thanks a lot for having me.